Good morning and welcome. Patriot Radio News Hour. Joe Jaquint solo today. Jason under the weather for the second day. He should be back Monday. I'm still convinced it's probably bird flu. Yeah, I don't know if you guys know this. A third person now has gotten bird flu. The second one in Michigan. And already, yes, I know, 3 whole people. All of them are fine. But this third one, he had a cough. Yeah, so that was new. And the government now talking about vaccines again. Here we go. Right, all this nonsense. It's just, I don't even know what to say about it. But I'm sure Jason will be fine. He'll be back on Monday, good Lord willing. But the show must go on. And our toll-free number, 800-951-0592. The website at allamericangold.com. Yeah, it's kind of interesting. Their Pfizer and Moderna, right? Their stocks are rising on this kind of stuff. And who knows? Maybe we'll have to break out the pure blood coins again if it happens. Let's hope not. But to wrap up the week, we had the inflation number we've all been waiting for come out. And well, it wasn't as low as they were hoping, but it was lower. Matter of fact, I guess the lowest since, the inflation started spiking. The core PCE deflator number, yes, let's just call it what it is, right? The number that actually doesn't track inflation, but somehow they want this to have credibility. The Fed's favorite inflation signal, and indeed, after last month had a stronger print, this month it got better. The PCE dropped from 0.3 to 0.2. The lowest monthly increase this year, so we know that, right? We've been getting mostly 0.3 all year. They were expecting 0.3. Like I said, it came in 2 cents. The core at 0.2. That was expected. The core PCE was 2.8. So, we'll call this in line pretty much with what they were expecting. Like I said, they were hoping to get down to a 2.7 core PCE. But again, 2.81 to 2.7537. Okay, so pretty much what they want you to believe is, look what a great job we've done, and it's below 3%. Well, at least this gauge is below 3%, but very interesting. I don't know if you guys saw. We've talked a lot about McDonald's and the struggle to get something that costs less than $5. Their CEO has gotten frustrated as people continually posting, whether it be on TikTok or X or Insta, whatever social media platform the people are using, the price of meals. Like Big Mac meals, right? The Big Mac, a drink and a fry, and it's $18. $17.50 to $18.50. The quarter pounder meals, $18. So he penned an open letter, and he said, McDonald's is not making any more money today on their food than they did 5 years ago. Matter of fact, the CEO said the cost for McDonald's has risen by 40% in the last 5 years, which is really interesting because you'd think, okay, McDonald's, first of all, they're huge. So, they're going to, prices for beef, potatoes, all the ingredients that they use, they're paying the lowest price possible, right? I mean, they're buying in bulk, right? So they're gonna pay the lowest price. Kind of like we do this all the time here at Bay, right? We offer volume discounts. Hey, if you're going to spend 50 grand, 100 grand, right, we're going to give you a better price. 40%. So that's interesting. What did the Federal Reserve say inflation was over the last 5 years? You know what the number was? I'm sure none of you will be surprised. Just under 22%. So McDonald's kind of proving out the theory that I have had, Jason and I have said for a long time. Whatever the Fed says inflation is, we just need to double it because they don't actually track the real inflation. See, because they'll be like, here's their logic. Well, if the hamburger meat costs too much, they'll buy something else. Well, McDonald's sells hamburgers, right? There's nothing else for them to buy, right? Hey, it's hamburgers and it's chicken, right? I mean, that's what they sell. And breakfast, hey, we sell Egg McMuffins, right? Well, that means you got to have eggs. Right? You got to have bread, right? I mean, there is no substituting. See, that's where all this logic is flawed. All these, people that sit there, they've never worked in the real world, and they think they're so damn smart. This is something that I think is really true. When it comes to inflation, the more educated they try to make you, they actually make it want it to be this super complicated thing when it really isn't. But it's kind of interesting, right? That kind of proves the theory. Whatever they said, so this 2.8 number, yeah, double it. Still over 5, isn't it? Patriot Radio News Hour. We'll be back. 800-951-0592, Patriot Radio News Hour here on this Friday. A quick look in here at the markets. The Dow is up right now off the highs, but up 50. The S&P's down 22. The Nasdaq's down almost 200 points. This time, Dell saying that, hey, guess what? Our backlog of server demand is starting to slow down. Of course, NVIDIA, they told you, hey, this AI stuff, be careful. I'm figuring out AI is code for data warehousing. In other words, getting ready for the digital currency and being able to use AI, artificial intelligence, that's it's really simple. They're going to be able to track everything, social credit scores, carbon footprints, all these things. This is bad, and we don't like this, and we don't like that, and now we can limit anything they want. They can take out anything they want, but you need to be able to have the power to do it, right? You need to have it. But Dell, kind of a disappointing on server backlog, and that's got the markets a little worried. And then this inflation number, they were hoping that it was going to be a little lower. But it was lower, just maybe not low enough. But right now, look at this 10-year note. Man, think about how crazy the 10-year note has been this week. 4.50. So another huge move in the debt markets. It's starting to get a little unnerving. It really is. We've got more details. Janet Yellen back to some of her old tricks again. Gold's down 10 right now. Silver's down 70 cents. It's going to be a great buying opportunity on silver today as well. We got some news on silver today as well. So we got a lot of things to get to. But remember, get diversified here. Don't play around with your wealth. We work hard to get to where we were at. All of our customers, they worked hard to be able to put some wealth insurance away, to put some gold away, to put silver away. You guys worked hard with your 401ks, your IRAs, the money that's in your bank, and they're getting ready. Listen, this is how boom and bust cycles work. They're getting ready to take it and especially when you start looking at banks. We got updates on banks today, and not in a good way either. Be more diversified for this next crash. Be more diversified for this next crash. Check out our friends over at YRefi. If you got $50,000 or more, you can get up to 10.25% fixed rates of returns. That's not correlated to Wall Street. Doesn't care about the Fed either. That's kind of cool. You can use it as income if you want, right? A lot of our customers have done that. It's an income maker for them now. Some of them say, hey, I don't need the income yet. I'm just going to keep compounding it. There's no fees. There's never a attack on principal. Check them out, investyrefy.com. That's the word invest, the letter Y, REFY.com. Or just make it easy. Just call them, 888-YREFY24. So we talked about the open letter from McDonald's. CEO saying, listen, it's not our fault. All of our costs are up 40%. Of course, that doesn't count labor, right? All this other stuff, right? When you really think about it, he's just talking about, hey, buying the burgers, buying the buns, buying the McNuggets, right? Buying the pickles and the ketchup and the mustard and the onions and buying the stuff to package it. It's up 40% in 5 years. Think about all of you out there that have big money sitting in your bank account because, it makes you feel good. Sure it does, right? I got $100,000 in the bank. I got $200,000, $300,000, whatever the number is. What the CEO of McDonald's just told you today was you've lost 40% of your value. Right? So when you sit there and you think, well, gold at $2,330, well, that's really good. Yeah. But all it's doing is keeping you whole, right? That's why we call it wealth insurance. Right? That's why we call it wealth insurance. Right? It was like $1,800. Right? Well, guess what? Gold's keeping up. That's what it does. How about Cracker Barrel? Remember, we had a big story about Cracker Barrel last week. Big miss, running out of money, had to basically get rid of their dividend and talking about closing stores. Today, they have a solution. Ready? Here's the solution for Cracker Barrel. Sales are falling. Less people are coming in. We're raising our prices another 5%. So that's been the solution. Get ready. Again, 2.8, double it, right? That's exactly what you need to understand, what the real rates of inflation are going to be. And then yesterday, the FDIC, all right, so that's the FDIC, the Federal Deposit Insurance Corporation, said unrealized losses in banks is accelerating once again. It's the 9th straight quarter of what the FDIC says are unusually high unrealized losses since the Federal Reserve began raising rates. They're now saying $517 billion in unrealized losses. Now, remember, how much money does the FDIC have? Oh, that's right. Like $100 billion, 120 max, maybe 130 probably at the highest. So now they're saying, well, we know that they have over $500 billion in unrealized losses. By the way, the problem bank list at the FDIC, no surprise here, grows again in the first quarter. Now, these are first quarter numbers, so this is through March. And obviously, no relief in sight yet. when it comes to interest rates. Matter of fact, what did the Treasury do over the weekend? Remember, they raised what they now believe the 10-year note yield is going to be. They raised it by a full point. And now the FDIC comes out and says, well, we may have another problem here because we just added more banks to the troubled bank list. Now, wouldn't you think if they knew banks were in trouble, they would let the customers know? Right? Because it's not for us. You know, and this is the thing. The banks are not your friend. Some people think they are. I mean, they can loan us money, right? That's kind of cool, right? And you pay them back, and they make a little bit. Excuse me, I had a sneeze. But they're not your friends. You know, when Jay Powell comes out or the FDIC, oh, we want you to feel great about it. Well, if a bank is in trouble, why wouldn't they tell you about it? Like I just told you about McDonald's. I told you about Cracker Barrel, Kohl's. I don't know about, I mean, that was the worst day. I think yesterday was the worst day in Kohl's stock history, I think. Don't quote me on that, but it was bad. Now the FDIC says, hey, we have unrealized losses of over $500 billion. So let's just ballpark it. 5 times more than the actual money that the FDIC has for the insurance. So any of you out there that have large amounts of cash in your banks, you're playing with fire. It's dangerous. You got to understand the rules, what Dodd-Frank laid out, right? Bail-ins is what's coming, not bail-outs, bail-ins. What does that mean? Simply put, the banks, they'll decide. They'll decide how much of your money you get to have access to. Now, they'll claim, well, we're not going to take your money, but we're going to give you some shares. You know, maybe you got $200,000 in there. Maybe, well, I'm under the limit. Okay. I just laid out. This is what they admit to are these troubled banks, right? This is just what they admit to. And the amount of banks every quarter now that they say are in trouble, they just keep adding it up and adding it up and adding it up. It's growing and growing and growing, and now the FDIC is already admitting, well, we know about at least 60, 68, and again, this number is a little old, so closing in on at least 100 banks that are bad. Now, we got 4,000 of them. But the problem is the people that really know think several thousand banks may be bad. But they admit to, well, we've got over $500 billion in unusually high unrealized losses. And if you only have 1/5 of that money set aside for insurance, well, that math doesn't work, does it? Now, what are they going to do? Go to the Treasury? Hey, Janet, hey, and of course, let's face it, as these banks start to go under, and they're going to go under, you start running into problems because all of a sudden, the 68 banks that they admit to becomes 300 banks. Then it becomes 600 banks, right? And then 1,000 banks, 2,000 banks, because they're all essentially holding the same thing. Even Bank of America today, their CEO, Brian Moynihan, the consumer and businesses have slowed way down, right? These are signs of stress that's occurring. this sign about the status of banks' unrealized losses getting worse. And now that these rate cuts aren't happening, all of a sudden the unrealized losses are skyrocketing again. So what do you think's going to happen? I'm just asking. Well, you think they can go to the Treasury? Hey, Janet, we need another $1 trillion to make good on this insurance. That's not what Dodd-Frank says. Doesn't say that at all. Right? But, Dodd-Frank, too big to fail. Right? It'll be fine. That's not what it says. What it simply says is we will go to the depositors in the event that needs another bailout. Of course, how are we going to get a digital currency? You know how it's going to come. Through a crash. That's how it always comes. Right? What did they do with Dodd-Frank? Really, what happened? Well, first, they did two things. One, they went on a massive debt spree that we're still in. And then two, shifted it to where the depositor gets left holding the bag. I'll walk you through it when we get back. 800-951-0592. So the FDIC comes out with their report for the first quarter of this year and says, hey, we've got more bad banks out there. We got more banks in trouble out there. A 50% increase in the number of bad banks this year compared to last year. So this number's getting a lot bigger. But you're like, well, but we haven't had, a lot of bank failures. We had more bank failures last year so far than this year, right? And this year, we've had one and then another one, right? They bought it out, right? They saving it from going under, having someone else take it over. And then, of course, remember that, and that New York Bank Corp, right? Steve Mnuchin, right, came in and tried to save the day there. Boy, that bank's still struggling, by the way. But I want to remind everybody, it's bad enough that I don't care if it's McDonald's, Kroger, Walmart, Cracker Barrel, Red Lobster, you name it. We know. Everywhere we go, we know how expensive things are. And the McDonald's CEO saying in an open letter, hey, it's not our fault. Our food costs are up 40%. Yet the Fed then the same time said that inflation was only 20%. It's twice as bad as what it really is. Like I said, all that money sitting in the bank for the last 5 years, it's lost 40% of its purchasing power. It has. Right? What you used to be able to buy for $60,000, right? You need $100,000, right? That's just how it works. Or listen, what cost $100,000 5 years ago, you needed $140,000. Those are the realities. That's bad enough. That's bad enough. But here's what makes it worse. Here's how Dodd-Frank really works. The next meltdown. Because as you know, we know the domino effect. They didn't fix too big to fail. Matter of fact, didn't we realize with Silicon Valley Bank, banks that, no offense, but $100 billion isn't that much money today anymore, right? When we look at debts and all that stuff. But even that was enough. $100 billion bank was enough. They had to come up with this bank program, right? Try to pretend that things were better than what they were. And now the FDIC says, well, the number of bad banks is up 50%. And oh, by the way, these unusually high unrealized losses that they're estimating at over $500 billion. Here's how it works. I probably shouldn't say if, when the next crisis hits, because this is what happens, it's a debt money system, and when you can't pay the debts, the system goes down. Right? It's pretty simple. And of course, with ridiculous policies, they've made the problem so much worse. Because all of this debt that's going bad is at super low rates. And if you try to save it, you got to refinance at these higher rates. The math it's just bad all around. But they're going to set a limit because they don't have the money, period. There's no way to get it. Right? You don't go to the Treasury and say, gosh, we need $1 trillion, $2 trillion, $5 trillion. Right? They saved the big hitters at Silicon Valley, but when it really goes, they're not saving anybody. So the first thing that's going to happen, anything over 250 is gone. It's a big problem for businesses. It's a big problem. Right? So now business is like, what do I do? Where do I go? After the 250 is gone, the insurance kicks in. Like I said, they've got, let's call it $130 billion. Something like that, if it's that high. I mean, just J.P. Morgan alone has insured deposits. Well, I don't know what the exact number is, but it's well over $1 trillion, right? Bank of America, U.S. Bank, right? Wells Fargo, Citi. Okay, well, what are you going to do? And here's the answer. They're going to the deposits. Look at, anybody, hey, if you don't have any money in your bank account at the end of the month, you probably don't need to worry too much, right? Probably don't need to worry too much. But it's the people that had month after month after month, year after year. Gosh, you always got your account balance is 100,000 plus every month, 200,000 plus every month. Tell you what we're going to do, Mr. Schmuckatelli. You really don't need this money. I mean, obviously, it's just been sitting there. We're just going to hold X amount of it for you. You can have access. Maybe it's $10,000. Maybe it's $25,000, whatever the number may be. And the rest of it, I mean, it's still there. You just can't have it. Right? You're going to get paper instead. It'll be like a stock in this new bank. And at some point in the future, we'll hopefully allow you to sell those shares and get all your money back. But in the meantime, you don't have access to that. And of course, you're like, well, wait a minute. Right? The stock market's down 50%. I may want to buy stocks now. Or housing's crashed again. I want to buy houses. I want to take advantage of what I've done. And I've saved. No, sorry. I mean, you can pay your current bills, but you don't have access. That's how it works. I'm just telling you, that's the system. I didn't make it up. That's what Dodd-Frank says. No bailouts. It's called bail-in. What do you think that means? That means they know they actually don't have the money for the insurance. Obviously they don't. And when it really goes, that's their plan. I don't know. Maybe you don't care. Maybe you think it's nuts. Maybe you think, well, gosh, it won't happen to me. But if you do think maybe Maybe you need to get some gold and silver put away instead. Patriot Radio News Hour. We'll be back after the break. 800-951-0592. Patriot Radio News Hour. Wrapping up the week here today and just letting everybody know exactly what to expect when this next crisis rolls out. That's just how it works. That's how it's going to work. That's how it's always worked. Well, since Dodd-Frank. You got to decide what you want to do and how you want to protect yourself. 800-951-0592. That is our toll-free number today. Right now, gold's down 10 at 23.30. Silver is off about 90 cents right now. We've been running silver $half at $260 a roll. Silver's down today, down to $250 a roll today. $20 gold pieces. Actually, gold prices went up today. I don't know. Maybe that's the Donald Trump effect, right? The guilty on all charges. Who knows what it is? But price is going to stay the same on $20 gold pieces here. $25.25 at 800-951-0592. And as we continue to watch, by the way, really quickly, an update with the debt. The Treasury letting it know that their balance sheet now is down another $100 billion. Another $100 billion. So that means, again, they're trying to make it look better. The Treasury is running down their bank account, right? They want to have $750 billion in there at all times. That's not what they've been doing. The big deficit jumps start occurring here starting this month, starting in June. So obviously here's the last day of May. Starting next week, we're going to see big jumps in debt again. And I don't know how it'll all work out. I really don't, as far as how we're going to try to pay for this debt, how many people are going to even want to buy this debt. On top of, here we go, we know the financial crisis that occurred, they didn't fix it. They just went and said, to heck with it, let's throw the Hail Mary. And that's really what they did. I mean, if you really think about it, they've taken the debt from what? $8 trillion to $42 trillion. By next year, how big is it going to be? Right, what are we really going to be talking about? Closing in on $50 trillion? And now, right, we've got the troubled banks growing again, numbers that seemingly are outrageous in the fact that, hey, we've got $100 billion and we've got, they admit to a $500 billion problem, but here's the thing. That problem gets worse every month. What's the problem going to be at the end of the year? $1 trillion? This is why. When you think about why is there so much demand in gold from these central banks, that's why. That's what you see. Why are all these countries buying gold? Why are these countries taking their gold and bringing it back home? That's why. 800-951-0592. That is our toll-free number. Chicago PMI was out today. No rebound in sight. Matter of fact, the lowest yet, 35.4. Awfully low. This is the lowest outside. So go back to the financial crisis. It's lower than that. We only had 1 month lower, and that was the start of COVID in the lockdowns. Anything below 50 is contraction. It came in at 35.4. Barometer fell at a faster pace. New orders fell at a faster pace. Employment fell at a faster pace. Inventories fell at a faster pace. Deliveries fell at a slower pace. Production fell at a slower pace. Backlogs fell at a faster pace. The only good part, they did say prices paid rose at a slower pace. So despite all the contractions, everything still costing more, according to the Chicago PMI that was out today. And again, I think that's helping, right? Because they can say, well, maybe we can get some rate cuts. And then last but not least, how bad is the silver deficit going to be? They're now saying this is going to be the third straight year that silver demand significantly exceeds silver supply. A lot of people here now are looking at a big move in silver. I'm one of those. Move above 30 is nice. That's not the big move. They're saying industrial demand is now closing in on 60% of all silver demand. That's a number that's 15 or 20% higher than just 2 years ago. So it just tells you where silver's headed. So those silver half dollars, great value today. We'll be right back after the break. $800-951-0592. By the way, aluminum now, the highest prices in years, as a smelter now in China is down. Remember, it was Australia, now China. It just continues to add here. Silver $half rolls down to $250 at 800-951-0592. $20 gold pieces, $2,525. And I'll just warn you again, don't keep too much money in those bank accounts. BMO, the latest now with worsening credit conditions. And this is a bank, this is a big enough bank to cause problems. They're saying that BMO, heavy in the trucking industry as well, causing another major problem for the bank. They've got loan loss provisions continuing to climb at BMO. They're saying that it's the seventh straight quarter in which loan loss provisions have risen at the bank. It is the highest figure in BMO history. Now, BMO only came around since 2015. So that's where this starts here. And they're saying that this is the largest amount of loan loss provisions. And the problem is, every quarter, the provisions get bigger. Every single quarter, 7 straight quarters, more loan loss, more loan loss, more loan loss, more loan loss. And they're saying now that there are issues in their transportation department. I guess they do a lot of trucking loans. I'm not sure exactly, but is up 210%. Write-offs also soaring as well. The same thing with the write-offs. Every quarter, writing off more and more and more and more. They're now saying gross impaired loans has shot up by over, almost 30% from the prior quarter. So things starting to get a little dicey here and saying that, again, these banks, we don't know which ones is am I saying, hey, BMO's going out of business? No, I'm not saying that. What I'm saying is things are getting uglier again, and just be ready. I think we're going to see, we've been waiting on a lot of these banks to see when these banks are going to be shut down by the FDIC. The problem bank list has grown 50% in a single year. A lot of these banks, we're starting to see loan loss provisions jumping by big amounts, 20%, 30%. We're seeing write-offs jumping by that amount as well, right? So this is another factor. Hey, we've got these bad loans. We're worried about these bad loans. Now all of a sudden, well, we're beyond worried about them. We've got to write them off. They're getting sent off to collections, right? They're taking hits on the balance sheet, and again, we just don't know what domino is going to cause it to fall. Here's the great thing: it's Friday. Enjoy the rest of the weekend. I'm going to be back with the half-empty cup. Join us if you can, but God bless. Have a great weekend. I'll be back. I'm sure Jason will too. We'll be back on Monday.